Hey gang, welcome to another one of these investor presentation reviews. I've been doing a few of these a week and plan to continue to do so. If you like what you're seeing, hit the like button, subscribe, and always leave me a comment if you want to suggest any companies to look at, and I'll certainly be happy to do that. You know, there's a lot of these SPACs going public, and I have a lot of stuff to review, so if you want anything specific that I might not get to otherwise, let me know. Today we're looking at another GRSV SPAC, Ardagh Metal Packaging, a can company, so we're kind of in the this is a real industry type of thing. GRSV took these guys public last month via reverse merger, via SPAC. There was some initial pop up to the 9% return range at max at the end of February 19th. After that, we saw our little SPAC sell-off that took this back to around NAV. So this is basically sitting right where the deal was made. So if this is an interesting company to look at, this might be a good time to buy because you're not paying a massive premium above NAV. And obviously the downside until merger is kind of limited if you decide to take back your $10 upon merger announcement and not redeem the shares. So let's look at what Ardagh Metal Packaging is. As I said, it is basically a can company, but hey, the future might be aluminum. It might not be plastics these days. Who knows? So you got your presenters, a guy from Ardagh Group, Ardagh Metal Packaging, GRSV holding 5. GRSV is a serial SPAC issuer. These guys have been through the ringer. This is 5 actually. They already had 6. So the deal for 6 came before 5, which is a bit odd. But what I like to do with these SPACs is when they have a lot of them is how have these SPACs performed since release. So generally they're going to launch at $10. So if you're above $10, you're sometimes doing okay. I mean, this one closed November 16th, so you've gotten a 50% return in like 5 years. Not terrible, not amazing in regard to some other stocks that have done amazingly well in the time frame. A similar story with Beverage Mobility, their second SPAC, up about 40-50% since then. How have they kind of managed since they really saw a drop off during the sell off? They kind of peaked in the 50-60% return range. Pretty good. PAE stock down below NAV right now. This one hasn't been a real winner for investors. You've basically lost money if you held it since the merger. Luminar, I think that stock ticker Laser is doing very well. You know, if you bought it $10, you're seeing a pretty solid return here, 170%. UMW Mortgage, I think this is kind of a loser in the last couple of months. They went public a few months ago, last year really. There was some hype about this one because, you know, we were right in the mortgage bubble, really, is all I can call it, given the low interest rates that are now rising, and the stock has kind of been hit since then. They've made a ton of money in those few months, but who knows what the future holds. There's really no up from here. When the rates are this low, they can't go much lower. And if they go higher, it's not good for mortgage companies because they are really making a lot of their money from refinances. And then Matterport, we talked about in the last video. Stock I like quite a lot, and I own, disclosure, I own that sucker. I also own this sucker, GRSV, disclosure on that. That's a pretty solid company. I think that's a good long-term hold. So what are we looking at here? Just some high-level insight, and it seems like their track record's not bad. You know, pretty good. A couple of stinkers, but they're not, you know, complete disasters, and a decent amount of winning choices here, and some decent companies in the mix as well. And they have, you know, they took Twinkies public. So if you're a fan of Twinkies, if you're looking for a Twinkie like that guy from that zombie movie, then hey, GRSV Holdings got your back. They're infusing that company with money and really keeping it afloat here. So AMP's infinitely recyclable products touch millions of customers. So you can kind of see the brands they work with. That's important when you're looking at canning companies. What contracts do they have? How much of their capacity is contracted out already? And I think right now, I know a little bit about the beverage can industry. There is more demand than there is supply across the industry. So there's like 3 or 4 big suppliers of cans. There's Ball, there's Crown Packaging, there's CanPack, there's a few others. There's Ardagh, which we're looking at here. And since, you know, hard seltzers came out, there's a lot of other seltzers in general have become more popular. There's a lot of demand for canned products. and the supply isn't there. So I think a lot of these companies are trying to catch up, and I think that's kind of what's happening here. And that Ardagh is probably expanding this canned beverage wine they have, and they thought that taking it public might generate more revenue, a better valuation rather for this part of the business. So if you don't know Ardagh Group is a holding company that owns a bunch of businesses, including a can company. So this is an interesting SPAC in that it isn't taking a private company public necessarily. It's taking a public company that encompasses a few businesses and spinning off one of that business, being the beverage can business, into its own unique entity. So that's an interesting take, and I think the reason for that, the reason Ardagh is doing that, is because they don't think that this individual business line is being valued as well as it should be within the combined entity that is Ardagh. Because if you look at Ardagh Group, they actually trade under stock ticker ARD. So until this merger happens, ARD includes this A&P business, right? So it's a $6.3 billion market cap business right now. Kind of went up a bit in the last couple of weeks after earnings were announced and after the merger was announced, because that's a beneficial thing for Ardagh Group, and we'll see why that is. But going back to A&P, Ardagh Metal Packaging, compelling investment opportunity. You've got infinitely recyclable products, which is important these days. You don't want to leave behind waste. It's a pure beverage can play, which I think makes it probably the only one that's publicly traded, at least, in terms of being able to buy a pure beverage can play, if you're interested in that. Financial highlights. So, I mean, this, like I said, this is already a revenue and probably free cash flow generating business, that's unique in some of these SPACs that we've gone through, and that this is a mature business that they're taking public via a reverse merger, via a split from its parent company, to kind of realize some of the value that might inherently be there, but not realized by the market. So you can see financial highlights. They estimated revenue of $3.8 billion, estimated adjusted Ebitda growing from $654 to $1.1 billion between 21 and 24. There's a lot of volume growth between 21 and 24, a lot of growth on the Ebitda side between 21 and 24 that they're kind of basing these valuations on. So if a lot of that comes through, I mean, 20% Ebitda growth is pretty solid, 52% volume growth is pretty solid, basically doubling your Ebitda between 21 and 24. A lot of good stuff. They're the number 2, number 3 player across multiple geographies. They've got a lot of contract lengths on the new capacity that they're bringing forward. So what are we looking at when we're looking at this company and kind of where the Ebitda was and where it's going? So this is a company that was acquired by Ardagh. We're coming back to that parent company, Ardagh Group, in 2015, 2016. A good market reputation. They sort of, what Ardagh does is acquires company, kind of repositions them, invest in certain things. So they invested in specialty cans, probably since they're part of a larger conglomerate now, they can sort of cut costs. They grew their Ebitda from 400 to 545, so not amazing growth in the span of those 5 years. And then the assumption or the hope from GRSV and the investors in this SPAC is that, hey, we've kind of done all these things. We've turned this company into a better run company, and now we're investing more into it, and we think we can grow this Ebitda at a much larger scale than we've grown it in the past. So there's a $1.8 billion investment to increase capacity by 55% and double Ebitda by 2024 with longer contracts and better pricing, and then a mix change to some of those specialty cans, which probably provide higher margin and adding additional value for future growth. With greater capacity, you can probably do more with greater capacity than you could if you didn't. So clearly, what Ardagh Group, the company that's kind of allowing GRSV to take this public, is thinking that, hey, we're making all of these investments in this business. If we keep this business under our shell, where the value hasn't been realized, none of that's probably going to matter. We're going to yield, some growth in this stock, but not what it would yield if it was a unique self-traded company and the value was realized on its own performance. So if we're making this investment, might as well spin it off and try to generate more value out of it, because the market can then focus on the growth within this company, the A&P, the new A&P company, and not the muted growth that might happen in Ardagh because they have a couple of other divisions. They also have a glass division that is basically half their revenue and half their Ebitda. So if that's not really growing and this starts to grow a lot, there might be some value realization within ARD, but that value realization might be a lot more if the company that's growing at 20% plus is on its own. It's valued on its own merit. And especially since it's a pure beverage can play, if you're looking for an investment like that, a recyclable investment, something that's in the, in that space of recyclables and environmental consciousness, etc., this might be an interesting investment. Whereas if it was under the parent company, you might not even know about it. And that was kind of my thing. Like I until I researched what this deal is a little bit, because it was confusing to me, I didn't want to go into this slide without knowing that this is what's happening, that a parent company is essentially allowing this split to happen via the SPAC reverse merger. Then you sort of realize what they might be aiming at here. So company overview. It's a global leader in sustainable aluminum and animal packaging solutions. They're number 2 in Europe, number 3 in North America, number 3 in Brazil. Like I said, other players here: Canpack in Europe, Ball, Crown, and the A&P is about 20% of overall canned market share, 15% in the North American space, 15% in Brazil. Obviously, there's potentially more expansion in all geographies that they have, and they mentioned that here. They have 24 facilities. They work with customers that require significant scale. If you think about how many cans Coca-Cola must produce a day to fill their soft drinks, and I know they do some of that in-house, but they might not do all of it in-house. Same with like hard seltzers company like LaCroix, etc. The production is off the charts, and I know the consumption of those products is huge, and I know that demand is huge, and I know that the supply isn't there. It's basically 100% at this point, right? That whatever the supply is used, and the producers want more. So that's why this is an interesting investment, whether you're thinking about Ball or CCK, Crown, or CP, which I don't think is publicly traded. It's an interesting investment. So market growth here is 5%, 5 to 7%, 6 to 10%. They don't specifically outline anything. Like, is Asia just not a market for any of these companies? Can A&P move into Asia? Can they move into Africa? Can they move into, I don't think Russia's shown here. Is Russia a market for them? Is other parts of South America, are those markets that are available to them? Or are they just not worthwhile, or are they just too small to matter at this point, and eventually they'll grow? That's a question I have here. I don't really know the answer to that. So they're leading the way in sustainability, blah, 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 reducing waste, moving to 100% renewable energy. I mean, aluminum, like they say here, is the most sustainable packaging material. I mean, obviously an aluminum company is going to say that, but it is something that recycles at a higher rate than plastics, than glass. Highest recycled content, so 3x of glass, 24x of plastics, so pretty solid here. You can kind of see the benefits here. They can be recycled and be back on the shelves in 60 days. You can almost achieve 100% circularity, which means that, hey, we're taking a can, we're reusing almost 100% of it. 75% of aluminum ever produced is still in use, so they're just reusing it. Most people recycle cans because you get 5 cents back or 10 cents back in Michigan and other states. Hey, yeah. And there's a low cost of ownership here. So good business here. If you're looking at what's the most sustainable packaging material, between the three, it's cans, seemingly. So that's interesting. They're passionate about social sustainability, great. Investment highlights, this is what's important here. And by the way, I kind of say that this PowerPoint is less good than some of the other ones I've seen here. It's kind of bland and boring. So they're not going for the wow factor here. They're just sort of saying, hey, this is what we are. We're a can company. We're not trying to fool you with cool graphics. The only graphics we have is somebody opening a LaCroix can, a grapefruit flavor, not my favorite. even though I love grapefruit, but I think other companies do grapefruit a bit better. High level seltzer talk right there, but I do like most LaCroix flavors. They are a very good company. Preeminent beverage play focused on sustainable products, long-term industry megatrends, baby, point to an inflection point in beverage can demand, a lot of opportunity for growth, and we have an entrepreneurial owner-manager culture with a deep bench, so that's probably a leadership thing. If we're looking at, hey, what's the lowest cost product here? Again, they're laying out cans as that valuation. They're saying, hey, if you're looking at sustainable things, cans are the way to go. You don't want glass, hard to recycle, not recycled often. You don't want plastics, hard to recycle, not recycled often. You want cans. So they're sort of pointing to that transition that, hey, customers want more of what the canned industry offers, whether it's coffee, tea, hard seltzer, health and wellness, sparkling water. They list bubbly under health and wellness, even though it's sparkling water, but whatever. Carbonated soft drinks, beer has always been the case, but those were kind of the standards. And then you've got these new product lines launching in the canned industries. You're moving into a more diversified customer base, which is good for any company because you're not dependent on, let's say, Coca-Cola or Pepsi or Budweiser, because then they have a lot of pricing pressure on you because, hey, we're 70% of your revenue, you're going to do what we want, otherwise you're kind of boned. Now there's more diversification, so they're less dependent on that one customer and potentially can have a better contract and longer contracts with any of these companies. Because if the demand is there, then there's going to be the demand for Ardagh as a whole and the industry as a whole in terms of the services they provide, which is a canned service. And then there's more exposure to specialty can mix, which I'm assuming is larger cans, different types of cans, potentially higher margin cans, went from 34% to 50% today and probably keeps growing. They're sort of saying, hey, there's going to be more stuff here in high growth categories. There's going to be more diversification as we move through the years. There's going to be more shifting towards these potentially higher margin specialty cans. And then we're sort of comparing, hey, this is us and this is Ball and Crown. So we're a pure play on A&P. I said we, like this is a sports team and I'm rooting for A&P. A&P is a pure play on cans, whereas Ball and Crown have other business lines. If you look at Ardagh Group as a whole, they're kind of like Crown in that, hey, half of our revenue was from cans, half was from glass and plastic products, probably glass. Now we're sort of spinning this part off, making it a pure can play. We're growing at a pretty decent clip. This is B capacity data based on 2021 to 2024 estimates. So, we're becoming the number 2 player in the can industry. We're growing, in terms of new capacity, we're growing at a much faster clip than Ball and Crown. And we have some upside here, whereas some more upside than some of these other players that might be out there on the market. And it'll be interesting to see how they're valued against Ball and Crown, especially Ball, since they're closer to them comparison in terms of, hey, what's our annual capacity and what kind of revenue are we getting from cans? So where are we going in terms of growth opportunities? New categories are clearly the play in North America and Europe. And Brazil is still traditional stuff. It doesn't seem like the bubblies and the whatever. Is that truly? I don't know if that's health and wellness. Okay, so bubblies and trulies and spindrifts, whatever, have penetrated that market. But clearly in North America they have. In Europe, they're both growing at a similar clip. In Brazil, it's still the traditional stuff. There's advantages in terms of cans, imagery. I don't know if I agree with this. Hey, I don't know what this means. That, hey, the imagery and quality and coolness of the aluminum can is growing at a much faster clip than, say, plastics. And then are people looking at environmental, regulatory, or plastic substitutions in terms of sustainability and regulation? It seems like that's a big thing in Europe, somewhat of a thing in North America, not really a huge thing in Brazil. They don't really care about the regulatory or environmental impact of plastics at the moment, I think. But honestly, a lot of this stuff will always change. The drink categories in flux. I remember thinking glass was the coolest, and now I'm like, whatever, cans are fine. And I'm sure other people are the same way. Customer preference, what are companies doing? They're also trending to recyclable packaging and recyclable content, and they're kind of saying that, hey, by X year we're going to be 100% returnable or recyclable. We're going to reduce emissions. We're going to do one of these things. And even Heineken saying, hey, in the Netherlands we're going to be 100% returnable bottles in the Netherlands by 2022. So the demand is there for recyclable products, and since cans are infinitely recyclable, as the sucker claimed, the demand is going to be there. And you can kind of see that, hey, when you look at product launches in North America, at least, where some of these things are growing at a high rate, we went from 31% of new products being launched in cans to around 75 in 2020. So the growth is there. If you're looking at new products being launched, a lot of them are canned products. And you kind of see that trend coming up due to sparkling water, which just, you either put it in a glass or a plastic bottle, but really most of them I've seen are in cans. Some are in glass bottles, not many in plastic bottles. And hard seltzers, new beers, new hard seltzers, new alcoholic drinks. And I think there's still upside for stuff like that. Hard seltzers aren't going to go anywhere soon, but hey, legalize marijuana or something like that, and you've got hemp drinks, you've got THC drinks. A lot of this stuff, there's a lot of opportunity for canned products, and if canned products are the best recyclable choice for companies who are committed to reducing their global footprint, then they're going to go with cans. Cans are the future, I think, and that's kind of what they're trying to sell here. Industry tailwinds are driven by customer preference. I think, Dasani's introducing aluminum cans for water, right? They're not going to do, Pepsi's not going to do bubbly in plastic, and then there's going to be Aquafina aluminum cans packaging in certain places. And then if you look at the Aluminum Association, which is clearly going to say good things about aluminum, they say, hey, 7 out of 10 adults would purchase a product that was better for the environment. And 80% of customers say that, hey, these cans are infinitely recyclable. I can use them forever. I don't have too many canned drinks in my fridge right now because we're not soda drinkers, but I do get the occasional sparkling water, so I'm clearly a part of this booming industry that they're talking about here. So there's a huge untapped market. This is what we're seeing in terms of the visible beverage can market. But hey, there's a ton of plastic beverage containers out there still, whether it's water, whether it's soft drinks, whatever. If some of those start transitioning to cans, the growth opportunity here is huge, is what they're claiming. Hey, a 1% shift in global plastic beverage containers translates to 18 billion units in AMP's addressable market. So it's 5% growth just due to a 1% shift. So that's pretty darn good, and AMP is well positioned for that because of their pretty big expansion in capacity. So that's solid. And like I said, current supply is sold out. Future new capacity is pre-sold. So there's demand. The marketplace currently is short of aluminum cans. Demand's going to grow, and supply is not going to be able to keep pace. So even with all the investments these guys are making, even with all the investments all the other companies are making, the growth's going to be there, but it's going to be constrained by the number of cans that they can produce. So highly visible forecast backed by customer contract. That's what I like about companies. If you have contracted customers, you're pretty much all set. You know where your revenue is coming from, and it's not going anywhere. These are pretty solid companies. These companies aren't going anywhere. Mark Anthony, Heineken, Coca-Cola, Pepsi-Cola, Croy, Diego, Monster energy drinks, etc. So they have 98% of their capacity already contracted or under negotiation with existing customers. Very small amount uncontracted. 2022 is the same. So long-term revenue should be stable. The problem is that long-term revenue probably has limited growth in terms of their revenue because if it's contracted for a couple of years, you're not changing pricing. But if you have the ability to change pricing in a beneficial way, which might be the case if there's a supply constraint, then potentially there's some solid revenue growth. And as they expand their capacity going into 2021 through 2024, they can potentially get better deals on some of those expanded capacity lines as well. Although some of these contracts may also have, hey, if you expand capacity by whatever, we get X of that as well. So it might be already inclusive. Good thing, top 10 customers, 60% of the revenue, but no single customers represents more than 17% of revenue. Still a high amount of concentration. Your top 10 customers are more than half of your revenue, and one customer is 17% of your revenue. That's a lot to lose if that customer suddenly chooses to go elsewhere. I don't think that that's a huge risk, just because, like I said, demand and supply constraints are going to drive these customers to whomever has available capacity. And with all three of these guys growing their capacity, all three of these guys will do pretty well. So it's going to be a matter of who's going to benefit the most. A&P is obviously growing their capacity the most without any equity being issued. And they are in a good position to take advantage of some of these growth trends and sustainability trends. So they're going to, GRSV is partnering with A&P on this expansion plan. Like I said, the capacity is growing from 39 billion cans to 60 by 2024. The 3-year payback in terms of their investment on some of these expansions. Where are they developing? Some locations in Europe, some locations in North America, a few locations in Brazil, and some of the customers that they have already were mentioned here. But that's good expansion if they can achieve this. Annual Ebitda growth of, 20% a year, basically doubling in 4 years. Pretty solid. And it seems like this is a realistic, it's a realistic assumption in terms of revenue growth, because that revenue growth and Ebitda is driven by expansion in capacity, not just some nonsense that they're doing on the back end to improve margins. It does seem like they're still improving margins in terms of their growth plan as well, but a lot of it is based on volume expansion, not just margin expansion. And they've already proven that they can actually improve margin with little to no volume expansion. So it's good to see that, hey, they're going to expand volume by quite a bit in the next couple of years, and a little bit of margin expansion will come along with that, which helps generate good Ebitda and also good free cash flow. That's another good thing about a company like this. It's a known model that already probably generates free cash flow, so it's not a cash burning company, so they don't need a lot of cash. And we'll talk about why that's important when we get to the structure of the deal. But it's a self-sustaining business that can essentially generate free cash flow that they can reinvest into the business and continue growing their volume if the demand is still there post this expansion here. So the worry here is that, hey, we might take on additional debt to fund this expansion, but this is a pretty good cash producing business. The free cash flow conversion is solid. Your Ebitda to your free cash flow is like 80 to 90%. Utilization is in the high 90s, probably close to 100 soon, and their contracts are 3 to 7 years, so the revenue's kind of reoccurring and pretty dependable. So you're going to be generating free cash flow every year, and that's a good thing as an investor. This is money that can be used to reinvest in the business, continue to grow volume, or to give back to investors in the future via some form of dividend. So that'll be interesting to see what they do with that money. I think right now they're going to be in that expansion phase, the growth phase, which should mean good things for the price if it's fairly valued today. But in the future, this might become an income producer in a few dozen years, like I think Ball probably is. I think Ardagh Group is currently as well, so they're dividend payers. Compelling growth trajectory, so expansion with current customers, new geographies with existing customers, moving, hey, rest of the world, excluding India and China. That's interesting. They can't get to India and China, which are both massive markets. Potentially there's just regulatory issues there, or they already have companies that do that within India and China where it makes it cost prohibitive and the margins aren't what they want them to be, and or there's regulatory things that they may have to deal with where India and China are kind of pushing things so that companies within the country do better than companies entering the country. And then expanding to new categories, still water, CBD, like I mentioned, health drinks, sparkling water, hard seltzer, wine, coffee, and tea are recent examples of where they've expanded. So I think cans are going to be needed for a while. I don't see anything coming out that's going to replace cans. So this is an interesting business model. And like I said, pure beverage can play, accelerating the demand, 12% revenue growth in the next couple of years on an annual basis. We're 10 billion cans short in North America, so preferable supply-demand dynamics. So their expanding volume is only going to help that. They're expanding there's strategic capacity expansion, like I said, and substantial profitability growth. So that's interesting to see. I think they think that, hey, not only are we going to be able to grow our revenue, we're potentially going to be able to extract better contract terms from some of our customers simply because, hey, they're dependent on us for something that has a high demand. And as long as that high demand cycle continues, there's always the risk that all of these companies will expand on the assumption that demand will continue to grow at a certain rate. And if that demand ever drops off a little bit, now the favorable supply-demand dynamics change, and you're 10 billion cans long in North America, and that there's 10 billion cans that could be produced that are no longer needed. This is where you kind of run into a risk. But I think with where we are in terms of sustainability efforts and the recyclability of cans, it's an interesting play, certainly in this environment. So you can kind of see historical financial performance here. So I opened up Excel just to write some of this down. So let's look at 2020. We got 3.45 billion in revenue. I'll use this to compare against some other companies. Ebitda, we've got 545. Ebitda, and then we've got free cash flow of 442. I want to see what the market cap is and the equity value once we kind of get there. So pretty okay growth, kind of muted in the last couple of years. Decent EBITDA growth, given some expanding margins and some revenue growth, and then solid cash conversion, free cash flow generation. I mean, this is a company that sort of prints money in a way. Revenues there, margins are solid, and a lot of those margins flow through to free cash flow because there probably hasn't been a ton of capex here in the last couple of years, as they've already sort of got their facilities in line. But now we've got, hey, some assumptions in the future. We're going to grow at 15% due to favorable supply and demand dynamics in North America. Brazil has got an accelerating shift from bottles to cans and increased off-premise consumptions in Europe, drink categories, and sort of a shift towards specialty cans. So really Americas and Brazil, North America and Brazil are the growth areas here. Europe's slightly less so. And then their EBITDA projections are kind of based on, hey, we're going to get better contract terms. We're going to get a better mix shifting towards specialty cans. We're going to improve our networks, and we're going to continue to become more efficient in certain areas. And what they're doing to get there is we're increasing capacity in North America. There's new lines and major investments in Brazil, and they're expecting to kind of double capacity in Brazil by 2024. And then same thing in Europe. And then this is your projection, right? The thing you're worried about is, hey, they've sort of done nothing for the last 3-4 years in terms of growth. 4% revenue growth is fine, but it's nothing amazing. And suddenly, hey, we're going to blow up to 12.5. We're going to blow up to 20% EBITDA growth. We're going to blow up to 22% free cash flow growth. Now, that's fantastic, but is it optimistic is the question. Can they really get better contract terms from their 10 partners that make up 60% of their revenue? At the end of the day, they're pretty dependent on each of those partners, 6% on average in revenue. Potentially, they could find somebody new, but who knows? Who knows if they can negotiate better terms. On the other hand, if there is supply and demand constraints, those other guys are probably going to say, yeah, we'll give you 1% more for your contract because we need this stuff and we can just kind of build it into our costs or charge slightly more for our canned products because the demand is going to be there. This is all dependent on a lot of expansion. You're going from 39 billion in capacity to 60 billion in 2024. So you can see that the revenue growth is probably going to be there just based on that expansion, as long as they can keep their demands, or as long as the market keeps those demand supply characteristics in force. So the revenue is going to be there. The problem is, are they expanding their margins by 5%? Seems somewhat optimistic. If you think about their margins staying closer to the 16% that they have now, you know, they're dropping off 20% of their EBITDA by 2024 if their margins don't improve. So that's a pretty big difference. So really, you're kind of hoping that this company is run efficiently as heck to get there, and that their contract terms are improving at a pretty decent clip to grow that EBITDA at this level. So they're 2021 to 2020. So, you know, you're kind of seeing, hey, we're adding an incremental EBITDA of 50 million from expansion projects to be completed before this is over. I don't think this is something I'm super worried about in terms of, hey, are they going to be able to improve that quickly? I think the difference in 2020 and 2021 is small enough. It's this kind of jump off point where after that they start growing at a pretty rapid clip. But there's still always risk even in 2021 because your margin's expanding at a decent clip between 20 and 21. So we'll see if that comes to fruition. So what's this deal valued at? So enterprise value of 8.5 billion, representing a 10.5 multiple of 2022 EBITDA and 12.1 multiple of 2021 EBITDA. Ardagh will retain 80% ownership of AMP, which is interesting. And as part of the transaction, AMP will raise 2.3 billion in new debt, representing a net leverage multiple of 3.3 of 2021 adjusted EBITDA. So they're basically valuing this at 6.1 billion, 6.07 billion, with an EV value, enterprise value of 8.5 billion. So I kind of want to see, hey, what's the multiple over sales? What's the multiple over EV? So you got a 2.4 multiple over revenue, over 2020 revenue, which is really the true revenue. You've got a 1.75 price over sales. Let's look at a company like Ball and what they're looking like in those same scenarios. Financials is kind of where I go to get an idea. So they've got a price over sales of 2.39. So you're looking at Ball, you're looking at AMP, 2.39 versus a 1.7. So they've got 11.6 billion in sales. Whoops. Their market cap is that over here. It's 27.7 billion. That jives Morningstar's right on the financials. What's their enterprise value? 27.7. Does this have debt? Yeah, 27.7. So let's say about 6.5 in debt minus cash. That's just high level. So we're talking about a 2.9 enterprise value multiple over sales, 2.39 market cap value over sales versus 1.7 and 2.4 on the same end. So essentially, based on 2020 results at least, it's between 20 to 30% more expensive versus AMP. So that's not a terrible valuation against your closest competitor. In terms of EBITDA, does this show EBITDA easily? It does show free cash flow though. So you've got a free cash flow of about 320 million, which is a lot lower than what AMP is showing. But those numbers are sometimes difficult to compare against. Capital, their net margins are in the 4% range. These were these gross margins? Probably gross margins, right? See, the issue with some of these presentations is that some of the stuff is very hard to compare against other carriers, but at least on paper, in terms of the revenue generation, assuming that some of their margins are sort of in line and some of their EBITDA is sort of in line, the valuation seems fair if we compare it against Crown Holdings. Morningstar, CCK, Morningstar. I like Morningstar just because it's very simple to look at financials via the financials tab. Crown Holdings, which is not as comparable, has a price over sales of 1.12. CCK has a 1.12, so market cap on AMP over sales is quite a lot higher. These guys have decent cash flow as well. And then if you just look at ARD, Ardagh itself, which currently contains AMP, this is a $6.2 billion valuation, which is basically what AMP is being valued at right now. Valued closer to $0.93, so really closer to CCK. So the question is the aluminum can world worth more than a world where you've got glass in the picture, which is kind of these two companies? And it seems like yes, if Ball is any indication. But Ball is also a better known name. I have Ball jars. I have one in front of me that I drink out of. So they do a lot of glass stuff that people know about. I wasn't really aware that they were such a big player in the beverage can space, but it seems like they are. And they're clearly getting a multiple that's driven probably by the market liking the company more than some of these others. And the question is whether AMP can sort of grow towards this multiple, whether it'll be stuck in between these two multiples, where it's a pure beverage play and an unknown mix, or if it'll sort of trend lower because it's still sort of an unknown name and Ball's getting a market multiplier for being a known name. It's interesting to see what happens there, but it's also interesting to look at this deal as a whole, because what's happening here is that since Ardagh is giving up partial ownership of AMP, they're getting a big cash infusion as a result. So this $2.3 billion in new debt is not going to AMP as a company to help them grow. It's going to the selling company, which is Ardagh Group, which is ARD stock right here, which is one of the reasons that if you look at their performance in the last couple of weeks, that's been positively received because, hey, we're getting a cash infusion. We're retaining 80% of this business that is suddenly now worth $6 billion in market cap, and we're using some cash to potentially acquire new companies and or pay off some of our debt. So if Ardagh is getting 80% of a $6 billion company, they're getting a $4.8 billion company on their books, and they're getting a $3.4 billion cash infusion. That's $8.2 billion in value for a $6.2 billion company with, $6 billion in debt, I think. So this is a $12 billion EV company that's getting an $8.2 billion valuation just for their can business. If the revenue of the other business is similar to this one, and that gets a valuation that's closer to CCK, you're basically easily fairly valued without assuming any sort of excessive growth, which, if the AMP story is to be believed, might not be the case. So to me, this transaction, as I look at it, it makes GRSV an interesting proposition because the valuation is decent in relation to, let's say, Ball, which is more of a pure can play. But it also makes Ardagh Group, that I didn't really know about before I looked at this valuation, an interesting proposition. Because you're getting, not only are you getting 80% of this AMP business, which is the majority of the business, so they're going to benefit from any growth here and any payouts that may come here. They hold a controlling interest in this company, so they're going to do whatever is better for Ardagh Group over what's better for AMP, although both will probably align most of the time. And they also still retain a glass business that produces equal Ebitda currently to this beverage can business and equal revenue as well. So that's interesting. And they're getting a cash infusion that'll help them become more nimble as a company and will remain as major beneficiaries of the free cash flow that is generated by this business. So they've kind of pushed some of this leveraging effect onto this holding, off of their holding company, which is ARD, onto this individual company, AMP, which is now slightly more leveraged because they took on new debt that they gave back to their previous holding company. And that's that's a lot to do to take a company public. But the reality is that Ardagh probably thought and looked at this and said, hey, we're going to grow this thing. And the market's not going to realize the value of this growth within our overall business because it's shadowed by this other slowly growing but still profitable glass business that we have. So if we spin it off via this GRSV SPAC, we can not only generate a decent amount of cash that we can use for internal company purposes, but we can also potentially reveal the true value of this business as growth happens and benefit from that, but also get a cash infusion from the PIPE proceeds, the debt that this AMP company is raising, and the cash in trust from GRSV that we can use for other things. So it's a good play by Ardagh Group, I think. And it's still an interesting proposition for owners of GRSV because they are somewhat getting saddled with a company that has already existed. So really, if you thought this business was a good business, you should have just been buying ARD stock for a while because this business was embedded in that. The problem is that you probably didn't know about this business. I didn't know about this business. And it's possible that the owners of other stocks didn't know that Ardagh contained this business, nor was it clear that this business was going to grow at the rate that they're projecting. But via taking it public via this GRSV SPAC, they can kind of make that more public and allow that value to be realized more easily. The other thing to know is that ARD, I think, is owned by holders, like 92% owned by internal holders. So they probably weren't selling at the valuations they had. So what they're trying to do here is they're trying to realize some of the value. And that might be good for them, but it might not be good for holders in the long term if they plan to sell these stocks when the valuation is truly realized, right? So that's something to keep in mind. Some stuff on the bottom here assumes the normal share price of 10 includes impact of warrants and earnouts. Earnout provides for additional shares of Ardagh that vest over 5 share price hurdles. Receive 12.1 million shares. So I do like to see that there's, with SPACs, there's always going to be dilution in that, whether it's for warrants or whether it's for the GRSV team or whether it's for the owners of the SPAC that are selling. But the dilution here isn't automatic. It's not happening right away. There are going to be additional shares issued via warrants and or earnouts, but they have kind of price targets. So they're not going to receive those shares until the share price is $13, $15, $16, $18, $19.50, etc. So that's something to keep in mind as well as an investor. Hey, by the time you reach $19.50, there's going to be a lot of additional dilution that happens here in the form of 12.1 million shares times 5 via those different price targets. And potentially at that point, there's no real incentive for some of these ownership shares to be held beyond that. So if somebody wants to cash out, they may be cashing out at that point. And that's kind of the risk you see with a split like this. If Ardagh is doing this to realize the true value of a company, it's potentially so that some of the internal shareholders can actually share in that true value via selling in the future. If that true value is never going to be realized under the ARD stock ticker within the entire group portfolio they have, the solution to that could be to realize it via a SPAC route. Not only are you getting a big cash boost, but you're also getting a potential expansion of the multiple that the stock market will give a company like this versus what it would give ARD as a whole. So how is this comparable to other companies? Similar thing we looked at before. But over here, we're going to grow at 12% in terms of capacity. We're going to grow our EBITDA at a higher rate. We're going to grow our income at a higher rate. Our capacity growth is going to be there. It's not going to be as big as Ball because they seem to already have bigger capacity. So even though their growth rate isn't as big, their starting point is a lot higher. But versus current, it's a big jump. What's BGI? Oh, beverage growth investment probably. So they're investing this much, they're investing this much, they're not showing how much they're investing. So they're investing about 10% of their revenue, they're investing about 5% of the revenue. So at the end of the day, when you look at these two companies, by 2024, Ball is still going to be the biggest maker of beverage cans, despite that relative growth in terms of capacity. But A&P is going to be catching up, and they're a pure play on cans. So the question is the market going to value this company at a similar multiple to Ball? Or does the market think that A&P is already fairly valued because they're a smaller player? Even though they're expanding at a rapid pace, they're still going to be behind a decent amount when it comes to Ball. They're going to be bigger than Crown probably, but they're going to be smaller than Ball. And Ball is getting that multiple because, one, they're the number one player. They have the biggest capacity. They probably have a better negotiating contract. So maybe they're not growing their EBITDA at a bigger clip. Maybe they're not growing their net income at a bigger clip. But their net income and EBITDA are already probably higher as a starting point, as is their revenue. You know, they're already generating $11 billion in revenue versus $3.4 billion for A&P. So their capacity is higher. And that's why the market's valuing them there. Now, if the market thinks that, hey, A&P's growth is suddenly very appealing, that could mean that, hey, our valuation is suddenly 35% higher, right? So there's potential upside here if the market can come to a conclusion that, hey, this growth is real, and this company is going to expand their margins and become a lot more profitable. We should probably reprice this to get it to a better multiple. You know, and if that's true, then I think there's upside here. And by 2024, if that's true, and you're looking at 5.5 billion in revenue at a similar multiple in revenue, right, a similar multiple as Ball, then you're suddenly double where you were. So this could potentially be a $22 stock, which doesn't seem like a lot, right? But it's a decent return over a couple of years for a mature, relatively mature cash-generating company, right? If you can double your stock in 3 to 4 years, 3 to 4 years, you're talking about a 20% annual return, something around there. That might not seem like an amazing deal in relation to some of the SPAC deals that we've seen in the past 6 months where, hey, I've made 50% in 6 months. That's not reality. That's not going to last forever. But GRSV seems like they at least have a path towards a decent return year over year if they can develop their capacity and take advantage of that newfound capacity to increase their margins and grow their EBITDA and grow their free cash flow. I think this is an interesting proposition, but for me, this doesn't seem like a buy GRSV type deal. It seems like Ardagh Group, ARD, is suddenly interesting because you're getting all of this. You're getting 80% of this as an Ardagh Group shareholder. You're getting a dividend while you wait, and you're also getting some other business that already generates free cash flow and positive EBITDA and solid revenue. It might not grow as quickly as this company, but you're also benefiting from this company. So I think there's a bit more safety in owning ARD because of the way the deal is structured. But I think owning GRSV is pretty interesting as well because this is going to grow at a faster clip if this is realized. So with the ARD, the downside might be slightly lower, but the upside is more limited. Whereas with GRSV, owning just A&P, the upside could be pretty decent. You know, I'm talking about annual returns of 15 to 20% if they can do what they claim they're doing within this presentation. And I don't think what they're claiming is outrageous. I just think it's potentially better than it's going to be, right? Can they really expand their Ebitda that much? Because so much of this is dependent on margin growth. And if Ball is growing their margin at a % improvement between 21 and 24, can these guys really get 4% out of what they're doing between 21 and 24? That's the major risk. I think the expansion is going to be there. That's not something that is an issue. I think the demand supply is going to remain where it is. As they grow their supply, they can fulfill the demand that's currently not being fulfilled. The revenue growth is probably going to be there. It's just, hey, can we expand those margins at a decent clip to really get to these EBITDA returns? And 22% is a lot, and if they can do that, then you've got a good valuation. Like I said, we already compared the revenue valuations to Ball. Over here, you're sort of looking at 2021, 2022 adjusted EBITDA valuations at current prices. If they can hit that, it's pretty darn good. It's pretty darn good. Crown isn't really valued where it is because of their business model being a bit more diversified, sort of similar to Ardagh. So what Ardagh is trying to do here by spitting out AMP, like I said, is, hey, if we can get this up to 15%, to 15x, like Ball, we're going to have a pretty good return, right? And it's possible. I don't think this is crazy. I think AMP is a decent model. I just think that the deal is structured in a way that it might benefit ARD shareholders more so than shareholders of this SPAC. And that's an interesting thing. It's an interesting thing to see. I'll have to dive more into those details to see whether I want to keep holding GRSV or whether I want to hold ARD. Because it's hard to tell with this overview. I kind of want to look at the ARD earnings announcement if one's already come out in relation to this transaction and see how that business looks, because that might be a more interesting business. So we'll see. For now, I'm going to continue holding GRSV. I think it's an interesting play, and it's one of those things where you're not going to double your money within 6 months. So the fact that this is still at $10 doesn't mean much to me. What I'm interested in is, hey, what's this thing going to look like in 2023? This has to be a long-term hold if you want to realize the value that might inherently be within the company. Because all of this value growth is based on two things. Three things, really. Based on the expansion of their capacity, which is probably going to happen, the expansion of their margins, which will happen, but whether or not it happens to the extent that they claim it will by 2024 is the question mark, and the expansion of the multiple to come closer to a company like Ball, which is more of a pure play in terms of canned beverages. And if all three of those happen, you're looking at a really good return. If two or three of those happen, you're probably looking at an okay return. You're probably better off investing in like the S&P 500 at that level. And if one or three of those things happen, then you're sort of going to be saying that, hey, this is probably valued okay at best. Maybe I'll get a couple percent out of this because the margins aren't really expanding as they hoped they would be. The market isn't valuing it close to the Ball or anything like that, but the revenue's growing. And that's, I think, the one that's guaranteed. The revenue is going to grow. It's, hey, is the market going to see that revenue growth as valuable enough to expand their margins? And is the company going to be able to expand their valuation, rather, not their margins? And is their company going to be able to expand their internal margins? Because if all three of those happen, then you're looking at a really, really, really solid company. That may even, if the margins expand to 20% by 2024, and their revenue's there, and they're generating $1 billion in cash flow, why wouldn't you value this higher than Ball if it's better at that point than Ball, And if that's the case, then this is 20% plus by 2024. And I think that's an interesting proposition. I think this is one I would probably hold long term. If it somehow explodes and reaches $20 by the end of the year, I'd probably get out at that point. But at $10, this is an interesting valuation. But it also, like I said, makes me think about Ardagh as a potential investment instead of this, because at that point you're getting 80% of this and some other stuff as well, and a dividend to wait while this story develops. And that's interesting. That's an interesting investment thesis as well. So those are my thoughts on Ardagh Group. You know, the one thing I'll say is that Ball sounds like a nice name, like a company that, you know, you can throw around with your dad, whereas Ardagh sounds like something an orc out of Lord of the Rings would say, so maybe that's why they're valued differently. But on the financial metrics, this is a good, mature company that has an interesting go public structure that may not necessarily be fully beneficial to holders of GRSV and then AMP, but maybe more beneficial to holders of Ardagh. So that's something for you to dive into as well. Do you want to hold this one? Do you want to hold Ardagh? If you like this company, you know, this is obviously a pure play on cans, so this is a better hold if you want exposure to that. But the other company is a holding company that has other things as well going and will benefit from the performance here. So interesting thesis here. I don't mind it. I think beverage cans are a good play, and I think I'll stay invested, but I'll also look at Ardagh as a potential shift if this isn't doing what I want it to be doing. And I think both of those companies should move hand in hand in a way, because Ardagh is going to benefit from AMP's performance as well. So that's it for me. Like always, thank you guys for watching. Thank you for staying tuned. And if you have any questions, leave a comment down below. If you want me to review any companies, let me know. And as always, I am not a qualified financial investor. Please make sure to talk to one before investing in anything. Just doing this as a hobby. So thanks for watching and have a good rest of your day.